is in this our current century, right? And I don't know. It is what it is, right? It is what it is. Cause this is what just happened is just funny. I've never experienced that before, though, right? But I know since yesterday, their Zoom has actually been acting up. So apologies for that. Okay. So Adedolamu, I hope you can hear us.
Okay, Victor. Yeah,
Okay.
yes, I can. Guys, apologies for the interruption. Of course, it's one of those things that we experience with this our current work mood. Technology can be funny at times.
I tell you,
So
I think
yeah,
one even happened while they were having a CEO meeting or something, and
exactly.
something just popped up and the person started sharing, and well,
Yeah, we all know that there will always be hackers that want to benefit from opportunities like this. So let's just
Hello,
we should room
Victor.
for.
okay, yes, I like it.
Yeah, please. This is what you should try to do. Maybe like don't use the same password or something or the same link
Yeah,
for subsequent meetings. Just make sure you send the link like 10, 15 minutes to the beginning of the meeting so that you censor the emails, then you just send it to those people that actually need the training so that it deter them from hacking these things. So they hack through the link.
yeah, yeah. I believe so.
That is what they do most of the times. It's
Okay,
crazy.
all right. Thank you.
All right. Yeah.
Okay, so let's proceed with our training. Okay, so I believe so. I was trying to talk about the question that somebody asked earlier that when we talk about performance, do we mean cash flow or do we mean profit? I think I've answered that. Of course, I explained that when we are looking at performance in financial analysis, in financial determine what will determine the value of the company. Of course, and I mentioned that we can arrive at free cash flow from profit. What we just need to do is to adjust our profit for non-cash items. So when I think when I was running through the model, I think I saw something like non-cash items. But if it is not there, we'll just do a brief discussion about it when we get there in the evaluation training. Okay, so I was trying to explain one other thing we also, when we are using the income approach, one other thing we also need to take cognizance of is our discount rate. Like I said earlier, what the thing that will apply to a bank, for instance, is not the same thing that will apply to a manufacturing or a retail company, for instance, because for example, when we are looking at, let's say we want to value a manufacturing company, and the discount rate we'll be using will be WACC. So of course, some of us, I think I saw one question earlier, somebody asking if all participants are accountants. Sorry if you are not an accountant, if the term we are using here, if they are new to you, apologies for that. But
I
I do.
think it was coming from the hackers.
Oh, okay,
Yes,
okay, okay, okay.
it's
So I should just assume that the terms we'll be using in this training, people are familiar with the terms, yeah?
I assume so, but we can always ask question as well.
Okay, okay. So we are free to ask questions. We are free to call us back on anything that we don't understand. Okay, I was saying that so when we are talking about work, let me just for the benefit of those that are not familiar with the term, it's just it means that weighted average cost of capital. So we know that for every business, the two major source, of course, apart from personal savings, the two major sources of capital is either capital from equity holders and capital from debt holders. And when we are saying that debt holders, we mean by you borrow money to finance your business, and by borrowing money, of course, you have to pay interest, you have to pay we have to repay the principal. So there is a cost to the money you are borrowing. Of course, we try to get that in percentage. You say you borrow 1 million, for instance, and then they're asking you that, okay, on this borrowing, you must repay interest of, let's say, 2%, 5%, whatever the interest rate is. That's a cost for the borrowing you are getting. And then for the equity holders, there is a cost to what you are giving them. Of course, we know that equity holders, they won't ask you to say, okay, I'm assuming ordinary shares, ordinary equity holders, they won't ask you to say their percentage is this, their percentage is that. The idea behind equity holder is the fact that they are the owner of the company, they are the risk takers, and of course, being for this thing being a company, their risk is limited to the amounts they invested, but that doesn't erase the fact that you must give them something for the risks they are taking on. So this thing you'll be paying them is what we refer to as the dividend. And of course, another benefit the equity holder also gets is a capital appreciation, share appreciation. When the share is going up, of course, the benefits to them when the company is doing well. That's why most times they want to know the value of their company. Let's say when they bought the shares into that company, they bought the shares at 10 naira per share, and then now after doing valuation, for example, let's look at the Dangote, for instance, in Nesu. Sorry, I'm trying to restrict us to Nigeria because, of course, we are all very familiar with this environment. So, for example, let's look at the Dangote or in Nesu. Let's assume that when they started the company, when they're issuing shares, they issued shares at 100 naira per share. But now we all know what their share price is saying. The equity holders would be really happy. Imagine somebody that invested into Nesu when the share price was just 15 naira, and then okay, and then okay, so let me just for the sake of those that are not Nigerians, let me just expand it a little bit. Let me take it to the world. Let me say let's use an Apple for instance, Apple or a Tesla or something. When they were starting out the company, the Microsoft, when they were starting out, you don't expect the share price to be as high as what it is now. So the equity holders, they will be happy in this share appreciation they are seeing. Okay, so that's the benefits they get. That's the so we may not have it like the way we always have for debt holders, where we have the interest rates clearly stated. But for equity holders, what they want to say is, okay, you've paid all your interest, you've paid all your obligations, whatever is remaining after paying them is theirs. Although you may want to retain part of the profits, of course, to grow the business, but at least the business is still theirs. So they know that they will get something, and the money you are investing into the business, they will still reap the benefits in the future. So there is a cost to what you give to the equity holders too. So when we are talking about work, we are saying with the average cost of capital, we're trying to look at the capital structure. So when I say capital structure, I mean what is the percentage of equity, what is the percentage of debt. I'm sure Victor has talked about this when we were doing the financial model, because of course we can't have your balance sheets and you have your equity, you have all those things without first of all looking at the capital structure assumptions. So when we say capital structure, we are trying to compare the percentage of each. Sorry, a minute. I sorry, just give me a minute, please. Apology, guys. I had to quickly receive one call. Apologies. Okay, so I was talking about the cost. So when we are talking about work, what we are simply trying to do is just to average the percentage of the capital structure of each source of fund to the cost of each source of fund. So we are trying to look at, okay, this is the cost of our debt. Average it with the cost of our equity. So what we'll get in that instance. So when we are looking at work, okay, let me just quickly say this. Let me quickly digress into a retail company or into a manufacturing company. So when we are doing the valuation of a manufacturing company, I mentioned something earlier talking about free cash flow to firm, free cash flow to equity. So when we are looking at a manufacturing company, before moving to free cash flow to firm, and we want to use work to discount their cash flow, what we should do is to use the free cash flow to firm, because the free cash flow to firm is still considering the impact of debt holders also. And then like this general term in valuation, we try to compare likes for likes. Now our work has the impact of debt holder and equity holders. If we should go forward to adjust for interest elements, to adjust for debt elements, and then we are using free cash flow to equity and we are discounting that with work, we are not comparing likes for likes, because our work is supposed to be for debt holder and for equity holders. So what the free cash flow will be using in that instance should be the free cash flow to firm. So this is mostly applicable for manufacturing firms. But now let's go back to our major course for today, which is a fintech. Now, our assumption in this model is to say that we are treating this fintech like a financial service, like a financial service firm. So we know that most of this fintech, they are under the financial service industry. So we treat them as such. So we want to value them the same way we value a bank. Although we know that they incur additional costs, they incur costs that are slightly above that of a normal traditional bank. But the fact is, they are still regulated. They are supposed to be regulated by CBN, of course, in Nigeria, regulated by CBN, which is Central Bank of Nigeria, regulated by SEC, so we still categorize them as a financial service. And one thing we should know, it also notes in valuation, is the fact that when we are looking at a financial service firm, okay, let me just throw this open to the whole floor. If you are looking at a bank, for instance, what will you say is the major driver of their revenue? What asset in the balance sheet is driving their revenue? It's a question to the whole house. You can just unmute and just say something. If you can unmute.
I think deposit.
Deposit. Okay. Any other person? So the question is, what is driving their revenue? So the revenue in this instance would be interest income. So what do you think is driving their revenue? Loans. Okay, yeah. So this person said loans. Okay, in that situation, we are all agreed that so the loan to a bank, is it a liability or is it an asset? So of course, when you're looking at the bank, when you're looking at the financial balance sheet of a bank, you will see loan, you will see borrowings, you will see loan and advances. Who can help me clarify between when you see borrowing and when you see loan and advances in the balance sheet of a bank? Which one is which?
Okay, this is Benga here. Thank you,
Okay.
Dolam.
Yeah.
Loans and advances, I think, are the ones that are given to the customers that come to ask for loans from the bank, while borrowings are the ones that the bank itself had to take or secure either from central bank or from another bank. So borrowing is a liability. Loan and advances will be termed as probably categorized somewhere else, but borrowing is a liability. Thank you.
Spot on. Again, I really appreciate that. So what we are trying to say in this instance is financial service firms, let me say almost all of them, including insurance, including fintech, they are balance sheet heavy. So what I mean by balance sheet heavy is the fact that if they don't have balance sheets, they won't have revenue. So what I'm trying to say in this essence is that their balance sheet is driving their income statement. Unlike manufacturing, yes, they have balance sheets, they have all those things, but their revenue is mostly from sales. Like when they sell, they have inventory. Yeah, when they sell inventory, they will have revenue. They don't need to, not necessarily fine. They may have liability relating to their that will drive their revenue, or assets that will drive their revenue. But the fact is, their profit or loss statement is standing on its own, unlike a financial service firm. So why I'm saying this is the fact that when we are looking at a financial service firm, or when we are trying to value a financial service firm, what we focus more on is first is the balance sheet. Okay, for instance, I did a valuation recently, and when my partner, some of you may know him, Tope Odukoya, when he was looking at the valuation, anytime we are doing valuation of everything with him, the first thing he will tell you to go to is the balance sheet. He wants to see loan to deposit ratio. He wants to see how their loan is growing. He wants to see how their deposit is growing, because that is what will drive what is in the income statement, and whatever is in the income statement is what will drive their free cash flow. Do we understand that logic?
Spot on.
Exactly. So, but for a manufacturing firm, for instance, we find we may still go to the balance sheet, but we are looking at the profit or loss statement. You can say, okay, they have this revenue, they have because they are what is their inventory like, what is their revenue like, what is their profit like. We can still focus on the profit or loss statement, and then we proceed from there to do our evaluation. But for a financial service firm, it is very, very important that we understand what the balance sheet is saying before we now move to this thing. Like Benga rightly said, borrowings. Yes, borrowing is not as heavy to a financial service firm. The reason being that sometimes you may not even be able to differentiate between what's which is which. So what we do for a financial service firm is to say that, okay, we just use we go ahead, instead of using free cash flow to firm, we use free cash flow to equity to do the evaluation. And then in that instance, I said it earlier, what do you think our discount rate, what do you think it will be? A question to the whole class. So I don't forget, I said, because of the nature of a financial service firm, yeah, we focus on the balance sheet. And then when we are focusing on the balance sheet, I'm trying as much as possible not to say the answer in the process of explaining what I'm trying to explaining this concept. So when we're looking at the balance sheets, now we know that they have borrowings, but sometimes it may be difficult to differentiate which is which one is loan, which one is deposit, which one is this, which one is that. What they have, their deposit is liability. Do you understand? And that liability is not from financing. It's just due to the nature of their business. They must have deposits before they will give out loans. So what we are trying to say in this instance is, in this situation, we usually use the free cash flow to equity. So the discount rate, what do you think it should be? Any question to the whole class? What do you think the discount rate should be in this instance?
I think it should be the cost of equity.
Yeah, thank you. Spot on. Cost of equity. I said it earlier. We do like for like. Now, because a bank or a financial service firm, what you definitely see liability in their business, and the liability is that is their business. They need to have deposits, and then they need to give out loan. So we don't really focus more on their borrowings. Yeah, fine. They may some of them will differentiate and say, okay, this is our borrowings. But if you look at it critically, you can open any financial statement. You see that the borrowing is not usually as heavy as it would be in a manufacturing firm, for instance. So what we try to do in that instance to say, okay, now we know that due to the nature of your firm, you always have borrowings, you always have deposits, you always have that liability. But what will matter most here in this case is, okay, what is your equity saying? Now, after having after knowing what the equity is saying, in that instance, we said we are comparing likes for likes. It will not make sense if you are using free cash flow to equity and we are using WACC as discount rate. Don't forget, WACC is a combination of both cost of equity and cost of debt. So using WACC in that instance would not be appropriate, because before arriving at your free cash flow to equity, you have adjusted your free cash flow to firm for the interest and whatever what have you that you pay to equity holders. So what you have is supposed to go, the free cash flow you have left is supposed to go to equity holders. In that instance, you use just cost of equity to do your valuation. So the essence of explaining this whole thing is the fact that in this evaluation, we will not be diving so deep into WACC. What we'll be focusing more on is our cost of equity, because we are doing a fintech company, which is a financial service firm. I hope that is clear. Okay, so now let me quickly explain the other approach, which is the market approach. So market approach is simply saying that, in a layman term, market approach is simply saying that you want to value this company by comparing it with a similar company. Yeah, so you have our Bootvest. So it's a fintech, and we know that we already have a bank like a fintech like Cowrywise, like Kuda, like all those things. So we want to see, okay, how do we value Bootvest? By looking at Kuda, for instance, or by looking at Cowrywise or Piggyvest or any of those fintechs. How do we value Bootvest using this? So we are looking at, so in this situation we use our comparable companies, or we use comparable transactions. Okay, so don't worry, I can see a question. How do we estimate cost of equity for valuation purposes, CAPM or dividend discount model? Okay, so when we get to, I don't want to rush us into that, because this one is just to explain. When we get to the major valuation, because of course in this our example, we'll be using the income approach. So when we get to that particular, when we start our valuation, we see how we calculate our cost of equity. Shegun, let me quickly, please hold your thoughts. Shegun Taiwo, please hold your thoughts. When we get there, we can come back to this question. We'll see it there. We'll see when we get there. Okay. So as I was saying, now let's look at the market approach. So market approach is saying, okay, we want to value Bootvest, looking at the financials or records of Kuda and the other banks. So in this situation, there are two major techniques that we can use. Sometimes we use comparable companies or use comparable transactions. Depending on the purpose. Sorry, I forgot to also mention that when you are doing a valuation, there are some key things that are very, very, very important. One of them is your valuation date. Your valuation date is as important as it can get. And then you must also know the purpose of your valuation. Okay, for instance, I want to do a valuation for, let's assume we want to sell good vest. We want to sell good vest to Kuda. Do you understand? So now that is supposed to be a transaction. So if I'm using the market approach, I must, in addition to using comparable companies, I must choose comparable transactions. Okay, the similar transaction of such that has happened in the past. What did they pay? How did they go about it? How did they estimate similar transactions? Do you understand? And then if you are using, of course, you have to use comparable companies to get my valuation. Now, the essence of valuation date is this. So, for example, we are using the market approach. We are trying to use a comparable company, for instance, and then we are looking at Kuda, we are looking at Cowry-wise, we're looking at Piggyverse, we're looking at their price to earnings, we're looking at their EV to EBITDA, enterprise value to EBITDA, we're looking at, all those multiples, we're looking at all those things. Now, the multiples, when we are sourcing for our information, the date is very important. The price to earnings in December 2021 of Kuda's price to earn in December 2021 will not be the same thing as their price to earnings in December 2020. Do you understand? And like I said, we must always compare likes for likes. This valuation we are doing, our valuation date is, for instance, December 31st, 2021. And then comparing the multiples of December 2020, do you think that would be appropriate? No, it won't be appropriate because the multiples of 2020 would not have considered the risk, the elements that happened in 2021 that would drive the price to earnings in 2021. So our valuation date is as important as it can get. Okay, so moving on. So when we are looking at market approach, we're just simply looking at, okay, the similar companies, what is their value, what is their price to earnings saying. So in that situation, what we are simply trying to get from similar companies are multiples. So when I say multiples, like I mentioned earlier, they are the PEs, they are the beta. What's the beta of this company? What's the price to earnings? What's the market cap of this company? What's the equity value and all those things. So just to test our understanding, can we differentiate between market cap and then equity? Of course, the book value of equity. Can anybody help us to differentiate between market capitalization? Sorry, when I say market cap, apologies. Sometimes I get carried away by all these abbreviations. So when I say when we say market capitalization, and then we are talking about book value of equity, probably Victor would have mentioned something relating to that, but can anybody just help us with what you understand? What is the difference between the two?
Okay, hello everyone. Yeah. Market capitalization is talking about the share price multiplied by the number of shares outstanding. That's if you multiply them, we'll be able to get the market capitalization. But the equity value is based on the last financial statement or the available financial statement. The total equity value, like the total equity, the amount, that is what the total equity value is.
Anybody, any other person that wants to try? Thank you very much. That's spot on. Any other person that wants to try? Just to make this class interactive.
Hello.
Yeah.
Yes. I just want to add that market value or market cap is more or less like the current value of the firm, but equity value is more or less like a historical value.
Yeah, okay. If we look at it from another angle, okay, thank you, Shegun Taiwo. Thank you, Shegun Taiwo. Okay, like the sorry, I didn't get your name. The first person that spoke, I didn't get your name. Like they rightly said, they are all correct. Yeah. So when we are talking about market cap, we are looking at the current share price of the particular company in the market. So when we say market, of course, it's not a market for paper, market for. So we are looking at okay in the stock on the stock exchange. What's the price of this company? What is it saying? All right, so the current market share price. So on the stock exchange, what's the price saying? Then we multiply it by the outstanding shares, like the first person said. That's the market cap. Whereas the equity value, the book value of equity, of course, I think Sheguntai was the last person that spoke said that is what the bank, what the company has it in its records. Of course, that is based on what they have been bringing historically. Of course, that may not reflect what their current market price is saying. Of course, we know that in when we are talking about market price, there are so many things that can determine market price. That's why you see when somebody like Elon Musk, when they tweet something like Tesla is going to invest in so and so, you see people rushing to buy Tesla. But the tweet doesn't mean that the Tesla is going to perform better or their profits is going to skyrocket. But because people see, it is the market is all about perception. This is Elon Musk, he's an authority based on his track record. They say they will do this, which is one thing that also that affected the price of Bitcoin. When you see people that are authorities, when they're saying something, doesn't mean that if you look at the company will start producing 1,000 or 1 million cars and they will supply to the whole world. But because of the perception, markets can be very, very, very flexible. It's all a matter of perception. Imagine recently there is a company that I think something happened to them. I'm sorry, I may not be 100% correct. And then it's just a matter of perception. And people were thinking, how come this company is going to fold up? I think it was Facebook. And then people just said and people, the company is going to fold up. And then you see, what's this guy's name? Zuckerberg losing billions in days. It's just because of perception. That is not the fact is people are still using Facebook, people are using WhatsApp, people are still using different applications, but the perception alone will drive the market. So what the company will have in their record, of course you don't expect the company to be changing their financials based on what the market is saying every minute. So in that instance, the book value of equity and the market cap, sometimes most of the time, they are not usually the same. So the major reason I'm saying this is this: you are valuing a company that is not a PLC. So when I say PLC, I mean publicly limited liability company. Of course, they are not publicly traded. It's a limited company like LTD. I mean private. It's a private company, and then you are looking at their financials. When you are looking at comparables, the comparables that you will get, they are usually publicly traded, because for you to even have their information, that means their information is publicly available. Are we together? So that means the information is publicly available. So we are looking at you now want to compare. So before in choosing our multiples, we try as much as possible to choose companies that are very, very similar. Don't forget, I said we try as much as possible to choose companies that are very, very similar. Now, we are looking at, let's say Bootvest, their book value of equity is just an example, is just 1 million. And then the public companies that we are seeing, they are like 10 billion, they are way too high compared to Bookvest. So in that instance, what we'll do is we try to compare the equity value, the book value of equity of those companies with Bootvest. We don't go ahead to look at market cap, because of course we can't see the market cap of Bootvest being a private company. When I say private company, that means they are not traded on the public exchange. They are trading their shares is usually, somebody wants to sell Bootvest, and then it's usually is not as exposed as public company. So now we are comparing the market cap of all those public companies, and you're comparing it to book value of equity of Bootvest. Trust me, you may be choosing the wrong multiples, you may be choosing the wrong comparables. So when I say comparables, I mean guideline public companies. You may be choosing the wrong comparables. So in that instance, what you should do is to look at, okay, what is the book value of equity? depending on the platform you are using, the platform that we use mostly in Deloitte, we usually see those information. We usually see the book value. We usually see the market value. I mean the market cap. So we can say, okay, this book value is still close to. Of course, it's a range. Most of the time we don't get to say a fixed amount. We see a range. Okay, it's between 1 million to 2 million, which is still similar to Bootfest. Okay, let me select this company too. Let me select this company, and then of course you choose the multiples of the companies that are similar. So now the multiples of those companies you are choosing, of course, you get the average, and then you use the average to multiply the book value of equity of Bootfest. So I will not be diving so much into market approach because of our time and because of the limitations of this particular company we are looking at. And then the last one is cost approach. Like cost approach is just straightforward. So what amount will, if you want to if you are replacing this company or this particular asset, what are we going to get for it? That's just the simple logic about the cost approach. Cost approach. Most of the time when we see people doing valuation, we usually find we use the cost approach depending on what you are valuing and depending on the circumstances surrounding your valuation. But most times we usually focus more on the income approach and the market approach. And I'm not trying to justify that one approach is better. So what we do most times when we are doing valuation is to say, okay, let's do market approach, let's do cost approach, let's do income approach. The essence of doing the 2 or 3 of those approaches is because we want to be sure that our valuation, the value we get using all these approaches, they are within the same range. I'm currently working on one fintech, it's a microfinance, but they are currently planning to move more into fintech. Now, I think I discussed there was a time I was chatting with Victor and we were talking about this particular company. The model they presented is looking so unrealistic. Now, what we try to do is after we have done the valuation using the income approach, we're like, okay, because so the company is a microfinance. You know the business model of a microfinance company is totally different from that of a fintech. Microfinance, what they do before, of course, in their own traditional setting, what they do majorly is to just get deposit, give out micro loans. But now they are looking into fintech. They want to start providing digital loans. They want to start providing, payment platforms. They want to start, and they have built model. So their model is taking more into the fintech. Now, the fact is they are still going to be doing their traditional microfinance services. How do we value that such a company? And what we have done is to say, okay, let's value this company using the income approach. Now, because we are not certain due to that's why I said in the beginning of this class that valuation is all about, is an art. You get, you just play around with numbers. You try to think it through. Like, okay, is this realistic? If I present this to anyone and I'm explaining my logic, will this person not query me to say, I think, based on the size, based on this, based on that, don't you think they should be higher than this, or don't you think we are overvaluing or we are undervaluing? So what we have done is to say, okay, this particular company, let's use market approach to value them. Of course, like I mentioned, market approach is to say we are trying to look for similar companies, similar public companies that are doing what they are about to do. So the value we arrive at using the market approach, is it within the same range as the value we arrive at using the income approach? So when we are presenting our report or our findings to anybody, we can defend to say, see, we use both market approach and the income approach. This is the value we are arriving at. Now, in the situation whereby the market approach is so the range is so wide compared to the income approach, 2 things might have happened. It's either the business of that company. In this situation, there's this particular company that I was saying, the market approach and the income approach, they are so far apart. And the reason is this: you can hardly see a company that is combining something like that, like it's combining both microfinance business and also a fintech. You will hardly see. So the multiples we have selected, the comparable companies that we are using, they are not as good as they are supposed to be because of the business model of this company we have this and microfinance we are trying to value. It's either you see a company that is solely into fintech or you see a company that is solely into microfinance. So if you are combining the 2, you might get, but it will be very, very, very few. So getting all those companies may be difficult. So what we have done in that instance to say, okay, you know what? Let's just rely more on the income approach, because the income approach will focus on what is the forecast saying. So of course, we always review companies' forecast before we proceed into valuation. Because trust me, no company will ever tell you that they'll be making loss in the next 2 years. They will never tell you that. Of course, you see companies projecting their interest income to be from 2020 and 2021. You see them saying they will do 50% increase, they will do so and so and so. Of course, as a valuation analyst or as a financial analyst, don't let me restrict to valuation. You must be able to read in between the lines. You must be able to read, okay, what have they done historically? What is the reason why they have said they will do so and so? So in this my example, it was tough comparing their historical to their forecast because of the new business model they want to bring in. Now, historically, you have been purely microfinance, but going forward, you want to compare microfinance and fintech. Of course, I don't expect your interest income or your revenue to be growing at 2%, 3%. I'm expecting it to skyrocket. But at the same time, I must look for a fintech company. What are they doing? What is the revenue? What is their projection like? Before you can say, okay, your projection is realistic or is not realistic. So in this instance, what we focus more, because it will be difficult to get multiples of a company that is doing that. We just focused more on the income approach, and then we are talking to, like I used to I like using the term. We are talking to the forecast. When I say talking, like, there's a way you look at forecast that you be between the lines and be like, okay, this is making sense, this is not making sense. How should I sensitize this? How should I, should I ask a specific risk premium, specific, let me start boring you with all those valuation terminologies. So now you start looking at all those things. So that's just an example, and I believe we all understand what we have been talking about so far. Yes, because right now we are delving more into the valuation concept. Okay, so I have a question. Should we consider track record of management when doing evaluation of a company? Yes, of course, we have to. So I sorry, I'm using most of my experiences. I did one valuation, and management was telling us that they are telling us that they will do so and so and so and so. First thing we always ask them is, this is your forecast. Has it been approved by the board? Because like this model we have built, companies don't just send it. They don't just send it out to whoever will do the evaluation or whoever will be their financial advisor. The board must sit down and agree on this forecast. I'm sure if Victor should start telling us about his experiences with companies' bosses, you will see that they must sit down and approve this forecast. In the place of sitting down to approve the forecast, they will also look at all the assumptions that they have made. I think there was a time I was talking to Victor, and we were talking about one financial model that he worked on, and he was telling me about how he usually puts a toggle. When I say toggle, where we can change, okay, what if you are forecasted that you do 100% of so and so and so, what if you do 50%? What if you do, different scenarios? You are trying to inculcate different scenarios into your model. Okay, management of look at it. And another thing we also do is to take their budget and then compare it with their actual performance. So most of the time when you're doing just evaluation engagements, you are not building model, you are just doing evaluation. Of course, you expect the management to give you their budget, you expect them to give you their historical financials, you expect them to give you their if they have financial model, you expect them to give you all those things. What we first of all do is to do like a variance analysis to say, okay, over the past 5 years, you've been budgeting that you'll be doing 1 million, 2 million, 3 million, and above. Now, what is your actual saying? So what we are simply trying to do in that instance is we are trying to look at the track record of management. If out of 5 years, 5 years historical, we can see that 3 or 4 years they've been doing above budget, and in their forecast they are saying they will do 5%, 6%. We can say, okay, based on your track record that you've been doing above budget, we may let some things fly in their forecast. But if looking at their budget and their historical performance, and we are saying that the variance between the actual and the budget is so significant, in that instance, the first thing that will trigger in us is to say there's something wrong with their forecast. We should look at the forecast critically. Do you understand? Have I answered your question? People. So yes, we look at track record of management, and we do that by most of the time doing variance analysis. Don't mind me. Evaluation is not just crunching numbers. It's understanding the business. It's first of all understanding business, and then understanding several things, understanding variance analysis, understanding financial model, understanding, because this is what you'll be working with. So you must know how they are, even you must even understand the basic accounting principle. They are telling you that, for example, a bank, what is their loan to deposit ratio saying? And over the historical period, their loan to deposit ratio has been only between the 50-60, and then going forward, what are they going to do? And then another thing you also need to look at is the regulatory requirement. For example, loan to deposit ratio in Nigeria is something around 65%, 65 to 70%. And then the company is telling you that their own loan to deposit ratio will be like 40%, 30%. And that's a trigger. That's to tell you that no, this is not possible based on regulatory requirements. By when I say regulatory requirements, I mean what are CBN asked banks to be doing. If CBN is telling you to be giving now 60% or 70% of your loan, and you're saying you give out 40%, of course, you as a financial analyst, you won't accept that. It's either you go back to the management to say, no, this is not what the regulatory, this thing is saying. You have to adjust your loan, of course, to reflect the appropriate this thing. Or over the historical period, you're looking at their cost of funds. Don't worry, we'll be looking at all those things in this our valuation. I'm moving on to the evaluation proper. Sorry, let me quickly confirm the time if we still have enough time. Okay, we still have enough time. So any other question based on what we've been talking about so far?
Okay, well done, Adedolamu. I want to ask, can we, in valuing a company or whatever we want to value, can we combine two approaches, like in getting our final value? Or like, okay, let's say we are weighting the market approach and the income approach after to get in the valuation of the company or the asset we want to value. Can we combine? Can we weight them together?
No. Okay, so sorry, what I didn't get your name, please.
Yeah, my name is Oriofe.
Okay, Oriofe, all right, thank you. So that's a very, very, very good question. So let me just answer that question with one of the experiences I have. So there was a time I did valuation of unquoted equities. Of course, I believe we all know what unquoted equity is. And so it's not valuation per se. So we are doing that job as audit assist. So that job, when I say audit assist, we know when they are auditing a firm, there are so many, based on accounting standards and all those things, there are so many things the company must carry at fair value. So it's a kind of scenario. So we are doing review. So what we are trying to say is the company. What I'm trying to say is the fact that the company has done the valuation with whoever did it for them, and they are sending it to us to look at. And then one of the mistakes that we observed, let me call it mistakes. So one of the things they did, I don't want to call it mistake because, like I said, valuation is an art. So one of the things they did is to combine. So they did market approach. They used price to earnings. They use it's a bank here. So they use price to earnings. They use price to book. Sorry, I will still mention something. If you notice that some of you might have noticed that when I've been talking about banks, I've not been mentioning EV to EBITDA, and there is a reason for that. There's a reason why I'm just mentioning price to earnings, price to book, and I will still explain that later. Okay, so the bank use price to earnings, they use price to book. Fine, it is the same approach. They are both market approach, yeah. But what they have now done, they're having at the value of the equities to say they now average the value they arrived at using price to earnings and the value they arrived at using price to book, and they are now calling that the value of the unquoted equity. So when we are reviewing, we are like, no, just stick to an approach. The essence of having price to earnings, price to book is just to check if you are within the same range. I mentioned something earlier. In doing your valuation, you must understand your business. And I also said, if you look at this example I gave on the bank I'm currently working on, the valuation I'm working on, they are into microfinance. They are they want to go into fintech. Now, if I'm now arriving at the value using both market approach and income approach, don't forget I said something. The market approach was tough because we could not really get a company that we could not really get comparables that are really similar. Do you understand? Now let's assume after I use the income approach, I have that their value as 10 million naira, and then using the market approach 10 million naira, the income approach is telling me their value is 100 million naira. Now, you know the reason why the gap between 10 million naira and 100 million naira is so wide is because the comparisons I'm choosing for the market approach, they are not appropriate comparables. The income I will stick more, me personally, is not there's no standard, there's no rule to say this is what you must choose. But looking at the situation of the business, I will stick more with the income approach because the income approach is based on the projection that they will do going forward. And the projection is on both microfinance as a business and then fintech company. So I won't want to rely on the market approach because the comparables may be difficult to get. So in most cases, what I have seen so far is the fact that there is always a reason why you always choose one approach over the other. Sometimes you might want to, for example, you are valuing an unquoted equity. And then when I say unquoted, I mean unquoted shares. And then unquoted means they are not publicly traded, they are not on the secondary exchange and all those things. So when I'm saying okay, I'm looking at that company and I'm saying that okay, I cannot use income approach in that instance. Why? When you are talking about unquoted, that means the company is private. Most of their information would not be publicly available. One. Now, the forecast they will give me, even when they are doing, for example, you are doing unquoted, there are so many companies in Nigeria that we don't know of. They are just, it's when you are doing unquoted equity valuation, they'll be like, which company is this? And then you start reading about them, trying to understand them. Now, their forecast, there's nothing that will benchmark it against because one, I don't even have their historical valuation. When you are asking this company, let's say, just an example, please, I'm not using any company as a case study here. Let's say a Dangote, for instance, they invest in one company that is called Come and Take Limited. Do you understand? They invest. So you don't know Come and Take Limited. You can't even find their financial statement anywhere else. And then they are the Come and Take Limited will not want to give you their budget or their forecast because they don't know what you want to use it for. They won't want to give you their budget or their forecast. And two, even if they give you, how are we going to compare their future performance against their historical performance? There's no way to compare. Now, they just give you forecast and you're using that forecast to do their valuation as at today. Do you think that using the income approach, do you think you get the right value for the company? I'm throwing the question back to you. Hello?
Income approach will be better. Income approach. Hello?
That's what I'm saying. So do you think you get the right value using the income
Yes.
approach?
Yeah.
Hello? I said, sorry, I didn't get that.
Yeah, I said the income approach will be better.
Okay, for me, no. I will stick to the market approach. You know why? Hello?
Hello, this is being. I said.
I'm with you.
The result
Okay.
is disjointed.
Exactly. So me, in that instance, I know that this company is a private company. I can't benchmark. I can't even verify their forecast because one thing you must first of all do as a valuation, as when you are doing valuation of a company, is you must first of all understand their forecast because company can give you anything. It's their forecast. You can't fight them. They can give you anything. So you must be able to say, oh God, this your forecast is realistic or is not reasonable. And if it is not reasonable, you start sensitizing. For example, you are valuing a first bank, for instance, and they are saying they will do this, they will do this, they will do this, they will do this, they will do this. The first thing you have to look at is what have you done historically? What is the similar companies? What are they doing? If you see if the focus they are giving you is too optimistic, you have to start bringing it down. Start sensitizing to say no. We don't think you can do 100% based on what you have done historically. We only think you can do 20%. But in this situation, I have a company that is not publicly traded. I can't get their information anywhere else. So what I would do is, and they are giving me forecasts to say over the next 5 years they will grow by so and so percent. They will be above the moon. They will be doing this. They will be doing that. It's their forecast. Yes, management is allowed to be extremely optimistic. It's their business. You get. But the fact is, I can't benchmark it against anything. So using that forecast to value their company on using the income approach, no, I won't do it. I may just do it for comparison's sake. What I would rather stick to is okay, I've heard what everything you say you do. Okay, I've heard you. Now let me go and look for similar companies. by looking for similar companies, what I'm switching towards in that situation is the market approach. Okay, similar companies, what is their price to earnings saying? What is their price to book saying? What is their EV to EBITDA saying? What is their several multiples? Look at that multiple and use it to value your company. And I'll put this in my report that because of so and so, I have sticked more. Even my evaluation conclusion, I have sticked more to market approach because of this so and so reason. So there's always a situation where that will push you towards choosing a particular approach over others. So that's why I said earlier that you must first of all understand, okay, what is the appropriate methods to use in this scenario. So when you're now doing something like that, and you're now aggregating both market approach and income approach, that will not be appropriate because one, you already said that your income approach will not give you the true value because of this particular situation. Now, the value that I have at using the income approach, you're now merging it with the value I have at the market approach. I really don't think that would be appropriate. Just stick to an approach and defend the reason why you have used that approach. You might have your income approach just to show them that, see, your income approach is saying that your value will be 1 million, while your market approach is saying your value will be 10 million, and I've stick to the market approach because of so and so. Do you understand?
Yes, I do. Thank you very much.
All right. Any other question, please? Hello? Hello? Any other question? Are we together? Hello, Victor, can you hear me?
Yeah, I can hear you. I can hear you.
Okay, all right. So I'm assuming there's no other question. Sorry?
Yes, sir. Yeah, sorry, I don't know whether this has been touched on already, but because we had I just wanted to find out, so if you are selecting the comparable company to use to value the unquoted equity, is there a way you can get access to other private companies, information to use, or you have to stick to a public company? And if you are using a public company, is there any adjustments that you do for the multiples, and what are those adjustments, and how do you go about those adjustments? I just wanted to be sure about that.
Very, very, very great question. Very nice question. So your first question on how do you select public companies? Are there things to look out for when you're selecting a public company? Yes, there are adjustments that we make. So the fact is, depending on the platform that you're using, for example, some people will select their comparables from Bloomberg, some people will select it from, of course, some people will select it from S&P Cap IQ, Standard and Poor Capital IQ is a platform. So people select it from different sources. But what I've observed from all these sources is the fact that most times they don't usually have information on private companies. Like we said, it's a private company. Do you get? So the reason why they are private is because they don't want their information to be publicly available. And the moment you can see their information on Bloomberg, on Cap IQ, on whatever platform you want to select your comparison from, it is, of course, you may see a few, but very few. So what I wanted, okay, so one of my experiences, I was selecting comparables from Cap IQ, S&P Cap IQ sometimes ago, and then I was looking for, it's a limited company, and I saw like 2 or 3 limited companies that are similar. But the reason why I couldn't use the limited company, I mean the private company, is because they don't have beta. So they will have probably the platform Cap IQ or Bloomberg. They're able to get their price to earnings. They're able to get whatever have you. And then I'm looking for, okay, I need beta. Of course, I'm assuming we all know, okay, when we get that, we'll explain better. So they don't have beta. So if they don't have beta is the measure of the risk that this company is taking. So how am I sure if the beta of my company I'm valuing is just 0.8, and then the limited companies that I'm looking at, since I cannot figure out their beta, and then I'm selecting their multiples, do you think that would be appropriate? No, it won't be appropriate because I can't compare the level of risk that both companies have. Do you get? But when you're looking at public companies, you see almost everything that you need. You see the beta, you see the market cap, you see the value of equity, you see this, you see everything. So now what we usually do is, after selecting all those companies, we make adjustments. we make adjustments. So one of the adjustments we make is to say we want to include size premium, we want to include specific risk premium, we want to we want to adjust better. So let me quickly mention this. If you are valuing a company in Nigeria, because of the nature of Africa, Nigeria, and all those things, we usually go beyond Africa to select comparables, but we usually don't go to developed markets. So I'm valuing a company, I'm valuing a bank in Nigeria. Or let me say, okay, I'm using a bank because of this our specific situation. We are trying to value Bootfest. So when I want to select comparables, I'll look at, okay, what is Nigeria saying? If I have enough comparables, good comparables in Nigeria, yes, I may restrict myself to Nigeria. But I'm looking at what comparisons I've been able to get. Let me expand to Africa, or let me first of all expand to West Africa. I'm looking at Ghana. I'm looking at countries in West, when they're a little bit developed in West Africa, and then okay, I'm still not satisfied with what I'm getting. Okay, let me expand to Africa. Then I'm looking at South Africa. I'm looking at Morocco. I'm looking at all those companies. If I say that okay, I still need more. I still need something that's more realistic. I can now expand to emerging markets. So we try to stop at emerging market. We try. So when I say we, I'm talking about Deloitte because I've seen valuations of other entities now whereby you see them using developed markets, but me, I don't buy that idea because I feel like developed markets would be too developed to be comparing the company in the developed markets for company, comparing a company in US to a company in Nigeria. I feel it to be too developed. So what we do is we split it to emerging markets. Then we start looking at India. We start looking at all this Sri Lanka. We don't do before we used to do China, but not anymore. China is way too advanced for Nigeria now. So all those, but the other emerging markets, we look at them. Now, what we now do after getting all those comparables is to say, okay, let's now start adjusting their multiples. For example, we adjust their beta. There's a way we regress the beta because the beta of that company would have I don't expect the risk they will face in an India, for instance, to be as high as what they will face in Nigeria or what they will face in Togo. Do you understand? So now we now start. There's a way we go about adjusting. We know regressing the beta, regressing their PE, regressing every of those things. Every of all those things. So there's we make adjustments. Yes, spot on. We make adjustments before arriving at the average multiple we use. I hope I've answered your questions.
Very well. Thank you very much.
Mm-hmm. All right. So any other question, please? So there's something I need to really mention, and that is on size premium. So size premium. So there are for depending on the firm, different firm. For example, I've seen the size premium of PwC before. I've seen that. I think I've seen that of EY. So they do these things based on survey. Of course, Deloitte definitely. We have our own. They do these things based on survey. We've seen different PE firms, different investment banks. They will tell you that they are using this size premium. So when we are talking about size premium is simply trying to consider the effect of the size of the company you are valuing and the size of the comparable. Do you understand? So we try to what is the effect? There's a way. Don't worry when we get there. I'm not sure we'll be going too deep into market approach, but there's a way we adjust all those figures to consider the effect of size. Another thing we always adjust for, and this is relevant to income approach, is specific risk premium. Specific risk premium is trying to consider the effect of this company, this Bootvest as a Bootvest. What is the risk that they are facing as Bootvest? Because even if I'm comparing Bootvest with Kuda, there may be something, maybe just be something as small as their CEO that will determine the level of risk they will face. Do you understand? So what is we try to say, okay, let us put a specific risk premium because Kuda has been in existence for like say 5, just an example, I'm just guessing. Let's say they have been in existence for like 5-6 years, or the other companies have been in existence for so and so period. Bootvest is just starting out. Of course, I don't expect the level of risk in Bootvest to be the same thing as level of risk in in CUDA, for instance. So what I do in that situation is to say, okay, let me know what, let me just include a specific risk premium for Bootvest. They say because they will face higher risk when we compare it to CUDA or when we compare it to other similar companies. But what we do most times is when we are using the income approach, we always we don't sensitize and also include specific risk premium. Reason being that when you are sensitizing, so when I say sensitize, I mean management has given you a forecast, and then you are looking at the forecast to say this is making sense, this is not making sense, and then you are using their historical performance or this thing to sensitize their forecast figure. So now you have sensitized the figure. It won't be, I'm not, you see people do it after sensitizing, they will still go ahead to ask specific risk premium. The essence of sensitizing is to consider is to look at the reality of the forecast itself. So you says you have sensitized, there is no, I feel like there is no, well, what we do is we usually try as much as possible not to include a specific risk premium. Is either we leave management forecast as it is, and then after, before arriving at our valuation, we put a discount to say, okay, this is we are including this discount to include the risk you're facing because we don't think your forecast is realistic enough, and then we include a discount, of course, at a percentage, we drop their value. Do you understand? Or we sensitize the forecast, and if we are satisfied with what we have sensitized and it is making sense to us, we just go straight to arriving at the value. Another thing we also look at is market discount, marketability discount. We call it marketability discount. The marketability discount is simply talking about, okay, this company, for example, you are buying a boot vest. Now, if you want to sell a boot vest and you want to sell, I don't know of any, I think InterSwitch, I'm not sure if they are public yet. I don't know of any fintech that is public. Of course, I'm trying as much as possible not to give it.
Transact is a PLC.
Transact, okay, thank you. So I'm looking at a Transact. If I want to sell the shares of a Transact and I want to sell the shares of a boot vest, which one do you think, even just from our layman experience, which one do you think people will want to buy more, Transact or Bootvest? It's a question to the house, please. Hello?
It's going to be Transact. Transact.
Exactly. So why do you think it will be Transact?
Because they are publicly traded, like
yes,
publicly listed. Those.
Yes, one, they are publicly listed, so people can easily go online and search for their historical performance, what have they been doing so far, and use that to make their decision. But for a Bootvest, for instance, I'm not sure if people will still be so skeptical to say, we are not sure this company will perform. People just come about with so many things, and it will not be easy to sell a Bootvest. The way it will be easy to sell is Transact. So in that situation, what we do is, okay, you know what, Bootvest, we are going to include a marketability discount. Do you get? So we just, things that we are just trying to make sure their value is as realistic as possible. Now, another thing we also do is we also try to include, when we are doing valuation, is we also try to add a control premium. Sorry, I believe we are noting all these things I'm talking about. A control premium is simply trying to look at, okay, what is the percentage? Okay, so let me just give you a brief insight into how to be value. Let's say we want to value a 40% of a company. In that situation, we are not valuing 100% of that company. And of course, when you are doing a shares valuation, you are basically valuing the business. So what we do is, okay, we first of all try to arrive at 100%, looking at everything that we've been talking about so far. Arrive at 100%, and then we now bring it down to, okay, at 100% of this company is 100 million. That's the value of the company, value of 100% share of the company. But the person that asks us to do this valuation only has 40% interest or whatever amount they have. Then what we do is to just do 40% of that 100% to have at the value of the 40% equity that you have in that business. Now, we now want to do a control premium. So what the company is now saying that, what if this person we are doing this valuation for has above 50%? Of course, that means that the person has controlling interest in that business. Now, if this person has control above 50%, we try to include a premium because this person, if this person wants to sell these shares, this person is at advantage. For example, let's say you have, I'm not sure who the highest shareholder is in Dangote, but let's say Dangote, for instance, Dangote as a man wants to sell his equity stake in Dangote Cement. He's the highest shareholder. Now, what we do is, okay, Dangote, let's assume he has 20% in Dangote cement. Now he wants to sell the whole of 20%. What we try to do, and it's slightly also that to just do evaluation to know the right price to quote for all those shares. What we do is, okay, no, I'm not talking about Dangote Holding Limited. Okay, they have the highest shareholder. I'm just talking about Dangote as individual. Okay, let's use Dangote Holding Limited. They want to sell their equity stake in Dangote Cement. Now, what we do is, okay, because you have controlling interest, you can, if whoever you sell these shares to, this person will have upper hand. This person can dictate what will happen to the company. So you have an advantage, and that advantage will push the value of that equity, of that interest that you have. That advantage you have will push it up a little bit. In that instance, we make sure we put a control premium because you have controlling interest in this firm. You can decide, you can remove CEO, you can, we all know about all this. You have power as you are more like the chairman. You can do and undo. So that is situation. We try to include a control premium to say yes, you have a higher. We should push this value higher because you are weight in this business. So I hope I've been able to do justice to some of the questions we've been asking. So I'm trying to go to. Okay. All right. So any other question asked? So I'm thinking we are ready. It's almost 12, and this class is just supposed to be for 2 hours. Apologies. I need to do something else. So I'm just trying to say, okay, maybe if we just use the whole of today to do basic explanation. So we know that the next time we are gathering, we are diving straight into the evaluation and then probably end the class. So any other questions, please ask any questions, anything that is coming to your mind. Because if you don't understand the basic principle, when we are doing evaluation, some things may be looking like, why are we including this? Why are we taking out this? Why are we adjusting for this? Why are we adjusting for that? Okay, so I also said I want to explain something about EV EBITDA. Okay, please, I want us to pay attention to this because this is important in Bootwest, being a fintech company. So I want somebody to tell me what EBITDA is. So I just want us to understand this particular thing. So when I was saying that when we are doing valuation of most banks, we usually concentrate more on price to earnings, price to book, and all those things, all those multiples. We may have EV to EBITDA, but we don't focus on EBITDA, EV to EBITDA. Can anybody tell me the reason? The way you understand it, why do you think we usually focus more on price to earnings, price to book, as against EV to EBITDA when we are doing valuation of financial services? Man? Anybody? Of course, I'll still give my opinion, but I just want us to say, like, okay, let's just interact. Hello, wait, please.
Can I talk?
Yes, please, go ahead.
Okay. So to my own understanding, okay, my name is Ibrahim. So to my own
Ibrahim, yeah?
Yeah.
Okay.
So to my understanding, I believe EV EBITDA is used to compare the trade strengths of a particular company to some of its peers in the industry. So but in the case of having Bootvest, a startup that is just coming up, so I believe it will not be cool for us to compare because we already have a lot of big companies in the industry. So we might not have a perfect match to compare the trade strengths of Bootvest to some of the key players already established in the industry.
Okay, thank you. Another opinion, please. Sorry, there's no wrong or right answer. It's a training session. That's why we are on this training. So please, let's go. I just want us to talk. We still have like 20 minutes. So any other person, please.
Hello?
Yes, please.
Can I try?
Yes, please. Go ahead.
Okay. I don't have my thoughts, very put together, but this is what I'm thinking. I'm thinking it's very similar to the idea of, free cash flow to equity and free cash flow to firm. For EBITDA, it is earnings before interest, taxation, depreciation, and amortization. Okay. So, I mean, EBITDA is before your earnings, before you take out your interest and those other items. So, I mean, since a bank is a leverage business, the interest that you pay on deposit and all of those things are more or less like some sort of interest expense And so you using EBITDA, you have already taken out those interests already. But normal EBITDA is not supposed to have taken out interest. So I think it's similar to the whole idea of using free cash flow to equity to value a leverage business rather than using free cash flow to firm.
All right. Thank you so much, Joseph. Thank you so much. Of course, don't let me, before I'll say my own opinion, I want two other people to talk.
Can I try?
Yes, please go ahead.
Okay, so if you EBITDA, right, it's like you trying to determine the fair value of a company, right? You're trying to derive the fair value of the company through a computation. Price to earnings ratio is market determined because the price is determined by the market, and then you have the earnings from your financial. So if you look at the hierarchy of fair valuation, that takes you to a level 1, which it's much because it's market determined, right? You can easily determine the fair value of the company, right? So that one, it's more appropriate for financial services listed, right? Because you can easily you see the price, you go to the financials, you see the earnings, so you can just do your P ratio. But the EBITDA, you have to still do some computation. So maybe that falls on that level further.
Okay. Thank you so much. One more person who wants to try. Sorry, there is no wrong or right answer. Just say what you think. Adewale Hamzat, do you want to try? Hello? Hello? Hilary Unachuku, sorry if I didn't pronounce your name well. Do you want to try? Why do we not use EV to EBITDA to value a bank? Maybe of course maybe we're using the market approach.
Hello, can you hear me?
Yes, I can.
Okay. I don't really have a good answer, but I think that for first it goes to the nature of banking, the business. So a bank doesn't have the same nature as a regular company. So EBITDA it's not really a good way to match it. I think it has to do with factors with because of EBITDA, it's earnings before things like taxation and amortization. It doesn't affect it the same way it does most companies, so it's not a real good match.
Okay.
I can.
Hilary, you really tried. Thank you for that. Thank you to all our speakers. Okay, so it's just an opinion. All right, now this is the reason. Joseph, I think you were spot on. You really explained. You did justice. Okay, this is the reason. Okay, let's look at a Dangote. Sorry, I'm using Dangote because it's a common content that almost everybody know. So let's look at a Dangote, for instance. Their revenue is driven by their products that they sell. Yeah. So when they sell Dangote cement, they make money. When they sell Dangote sugar, they make money, and then that is their source of revenue. Yes, they may have interest income, but the interest income in Dangote is not the primary. Is not from their primary operation. Their primary operation is produce, market, and sell. Now, the interest income they are having is just okay. Because of course they are trying to hedge their risk. They invested in First Bank. They invested in this. They invested in that. They gave loans to so and so, and then they are having interest income. And another thing is their interest expense. Yes, they borrowed money to pay whatever borrowings they have. I mean, they pay interest on whatever borrowings they have and all those things. But that interest they are paying is not their primary cost of production. It's just cost of finance. Now, their primary cost of production is all the things they will buy. Like, for example, I don't know how they produce cement, but they have cost of production. They are the primary cost of production. So now what we are trying to do when we are valuing a company is to value the company based on the primary operation of that company. So we don't look at they made interest income, they made this. When even if we have all those things, there's something we call adjustment for non-cash items. So when we arrive at our EBITDA, because when we are doing income, even when we arrive at our EBITDA for a Dangote, for instance, we still go ahead to adjust that EBITDA. what we are trying to take out, we call it adjusted EBITDA. What we are trying to take out from that EBITDA we have that is, what are the things that they are just one-off? They are not something that they have on a regular basis. For example, they have fair value gain, they have, all those things that they are just one-off items. Those things are not speaking to the primary operation of Dangote Cement as a manufacturing company. So we take all those things out. Now, in the case of a bank, or let me say a bank. Now, what is their operation? Their primary source of income is giving out loan. Now, when they give out loan, they receive interest income on loan. Now, looking at EBITDA is saying earnings before interest, tax, depreciation and amortization. Now, if we take out interest from profit of a bank, from revenue of a bank, what do we have left? We have nothing. Do we understand? So what we have nothing. So EBITDA is not an appropriate multiple because they don't have any other earnings. So the only earning they have is interest income. So saying that, okay, yeah, earnings before interest, and then we are taking out the interest income, or we are taking out the interest expenses, and the only cost they have is interest expenses, of course, in addition to operating costs, staff salary, general admin, and all those things. But the major cost to earn that interest income, they first of all have to get deposits, and that deposits, they'll give out interest on that deposit. Of course, they give out interest on fixed deposits, interest on current, and all those things. They give out interest on those deposits. So if you take out the interest income, the interest expenses, do we have any other earnings as a bank? Hello? So let me say, do we have any other earnings from primary operation? No, we don't. So using EV to EBITDA would not be an appropriate multiple to value a bank. The only situation where we can say, okay, we want to try out EV to EBITDA is if the bank, or if I don't want to call it a bank, because the moment we call it a bank, we are saying they already have their source of income, their source of revenue is interest and this thing. But if, let's say, the business, although it is similar to a bank, but they have another thing that is giving them that they are generating income from, though it is similar to a bank. I think I did something like that. I don't want to mention the name of this. It's one of the regulators. So we did one valuation of that particular listing. And then we are looking at an unquoted equity. So the particular bank invested in like 5 or 6 unquoted equities. And then all the investment they are also into financial services. But there's a particular one that if you don't read their, there's in this financial statement, in the financial reports of a company, you will see principal activities. If you don't read the principal activity of that particular institution, you will think it's a bank. You will think they are generating their money from interest. Well, after reading the principal activities, you discover that, oh boy, these people, they are not banks, so they don't even give out loan. You understand? So they don't even give out loan, and then we start with, okay, now this in this situation, though it is from the surface looking like it's a bank, if you don't look at it critically, that's when we now, okay, in this situation they have other sources. Hello? 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 Okay, so that's when we now assume that in that particular situation we can use EV to EBITDA. But most cases, for a typical bank, we can't use EV to EBITDA because their earnings is interest income. So the best thing to just do is to use other multiples like price to earnings, price to book, and of course I already explained the concept of enterprise value. And EV to EBITDA means enterprise value over EBITDA. And I already explained enterprise values to include both debt and equity impact. So what I'm saying is, okay, when we are using enterprise value, we know that banks, they don't really, we may not be able to say this is their borrowings. They always have liabilities, which is their deposits. And deposits is usually a huge chunk of their financial statements. Deposits, that's the way they generate income. So they have deposits. So we can't be saying, okay, we want to use their enterprise value, because in the first place, enterprise value is both deposit, equity, and this thing, equity and debt. So both the numerator, which is the EV, and the denominator, which is the EBITDA, they are not appropriate to use to value a bank. Yeah, do we get the logic now? Hello? Hello?
Hello. So in this is Benga.
Okay.
Thank you. So in valuing a bank, well, from what you just explained now, you're saying
Yes.
It's not appropriate to use both the enterprise value to value a bank from what you've just explained now.
Okay.
No, I'm saying, is that the conclusion?
No, that's not the that's not the conclusion. I'm saying we're not talking about enterprise value. We are talking about EV to EBITDA multiple. Do you understand?
Okay, that's clear now.
EV over EBITDA, it's a multiple from a comparable company, and then we multiply it by enterprise value of that bank to arrive at their value. So we are talking as a multiple. It is not appropriate because EBITDA in the first place, how we arrive at EBITDA, and then secondly, how do we arrive at EV, which is the enterprise value? Do you get? I'm not saying enterprise value itself is not appropriate. When we are using enterprise value, I think I explained this earlier. When we are using enterprise value, because of the nature, are we together? Because of the nature of a bank, we go ahead to break down that enterprise value into equity value. Do you get? Hello?
Yes.
Okay, so that's what I'm saying. I'm not saying enterprise value is not, but I'm saying as a multiple, EV over EBITDA as a multiple will not give us the appropriate thing to use for our valuation. So we have just 8 minutes left. Let's open the floor to any discussion, whatever we think we should talk about. Because I think any questions, any opinion, and then please feel free to ask.
Hello, sir. Yes, hello.
Yes, I'm with you, please.
Okay, so earlier on, I asked a question about you making adjustments to the multiples of publicly traded companies.
Okay.
And you were talking about when you were talking about the adjustments, you made mention of the risk premium. So I wanted to find out whether some of these adjustments, such as for size, for marketability, and control, you do it. You make the adjustments to the risk premium, or what number do you make the adjustments to specifically?
Okay, so if I get you correctly, when you say risk premium, I understand what it is, but in what context are you talking about risk premium?
In terms of finding the cost of equity, like the risk premium that you use to arrive at the cost of equity.
Okay. Okay.
Because I heard you mention risk premium. I don't know whether it is that risk premium that you're referring to.
Okay, so yes, let me just answer your question. We will not be diving into what's it called, into WAC, but I think at this junction I just need to say something briefly about CAPM. CAPM is capital asset pricing model. So it's a model that we use to determine the cost of equity. Okay, so now when we're talking about CAPM, can you hear me? So
Yes,
the CAPM formula is simply risk-free rates plus, of course, we have our beta into bracket, then we multiply our beta by market risk minus risk-free. Yeah. Now, so that beta into brackets RM minus RF, that is simply talking about the equity risk premium. Now, there is something we do depending on whatever approach whatever way you are going to go about it. So in what I've seen so far, what I've seen is there are some people that will leave their CAPM as just that formula, RF plus beta into brackets, blah, 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 and that's all. But there are some people that will go ahead to modify that CAPM. So in the process of modifying the CAPM, they will include specific risk premium, size premium, so what they're just trying to do is after having all those, they'll just be doing plus specific risk premium plus so and so plus so and so. In that situation, since you have adjusted your discount rate, can you hear me? Since you have adjusted your discount rate, it will not be good to go and start adjusting your forecast again. Do you understand what I'm trying to say? Hello?
Yes.
Now, so now you can say, okay, now you have CAPM, the formula as it is. Now you don't want to modify it. You've included risk, marketability, you've got size premium, you've plus so and so plus so and so, whatever you have. Even the country risk, we also adjust for country risk premium. For example, in Nigeria and in South Africa, we don't have the same risk as a country. So now you adjust for countries view, and then you have adjusted those things in your CAPM and your capital as the price model. So when you are doing your forecast again, when you are doing your whatever multiple you want to use, and then you now start, okay, of course, when you're using CAPM, you don't go ahead to use multiple. I'm talking about CAPM in the light of income approach, because you want to discount that. CAPM is just to discount your future cash flow. Now, in that situation, I don't expect you, after arriving at your value, to now start adjusting for size premium, for specific risk premium, for all those things again, because the discount rate you are using to discount that particular cash flow, you have already adjusted for all the things, all the situations that will come into play. Do you understand? So there are two ways. It's either you adjust your CAPM, or you use your CAPM as it is, and then after rising at your value, you now start adjusting for all those premium discounts, premium as it is. Do you understand?
Yeah, absolutely.
All right.
Makes a lot of sense. Thank you very
Yeah.
much.
All right. So any other question? Hello. Okay. In the light of no question, I think
Sorry, hello.
yes,
Sorry,
please go ahead.
hello.
Yes,
Okay,
please.
I asked a question on the chat box. I said for each sector, like manufacturing, construction, and so on, like is there a certain valuation approach you can use, or you can use anyone?
So evaluation approach is not dependent on sector. Yeah, it is not
Oh,
dependent on
okay.
sector. It is dependent on the circumstances surrounding that valuation itself.
Okay, okay.
Do you understand? This is not, it's not sector based. If you feel like, so I personally I prefer income approach, because I feel like income approach is just getting the value of the bank from getting the value of the company from the forecast of the company itself. Of course, I have to sensitize the forecast if it is not making sense. Then, but depending on the scenario, depending on, okay, if is there something that will make you not want to rely on the income approach, then switch to market approach. If there's something that will not make you want to like the market approach, switch to income approach. Just that you must be able to defend whichever approach you are using, or you use both approaches. If you know that, okay, they are fine, you use both approaches, and then at the end of the day, you just the reason why you're using both approaches is just to compare. This is this, and then after comparing, you can say, okay, I think I will stick more to market approach, I'll stick up to income approach. But of course, you have to tell whoever you're doing the valuation for is to say that, okay, your market approach is showing this, your income approach is showing this, but I'm saying your value is, I'm basing my conclusion on market approach because of this. Do you get? There is not, it's not industry specific. Are we together? Okay, guys, I think I just have to stop here. I'll just I really enjoy this class. It's been an interesting session, and apologies for the fact that we are not able to start the evaluation itself, because I feel if we don't understand the basic principle as it is, we may not be, if we don't understand basic principle as it is, we may not be able to understand it when we delve deep into the valuation. And Shegun asked if there are rules and don'ts when you're doing valuation. Of course, there are do's and don'ts, but there is no, unlike accounting, that you have standard, you have this, you have that. Yes, there are some companies that come up with business valuation standard. For example, in Deloitte, we have business valuation standard. Just trying to teach us, how do you go about doing this, how do we want to do this, but there is no globally accepted standards to say that, you must do this, you must. Of course, they are just basic common sense. Of course, like I said, one of the do's and don'ts is, I don't expect it to be, when you are using equity value, and I'm saying when you want to use equity, you're saying equity value and you're discounting it with WACC. That's, of course, that even without telling anybody, that's a blunder. You can't be discounting equity value with WACC. As we are discounting enterprise value with WACC, yes, that's, so if this thing as long as it's equity value, just use cost of equity. Basics, just simple do's and don'ts like that. But I don't know of any globally accepted, this is the standard. But there are company specific company will tell you that do this approach, use this approach, and of course it must make sense to any valuation experts that are looking at your work. Do you understand? Shegun? Okay, in the light of that, I'm handing over to Victor. Thank you everybody for this session. Victor, please, over to you. Thank you, guys.
All right, thank you so much for that great session, right? And apologies for the break in transmission. I just got an email from Zoom, right? Someone actually copied the the link and pasted it on Twitter for the Yaka guys, right? So at least we've been able to sort that out, and that's just a lesson to learn against the next one. So big thanks to everyone. I'm quite sure we've learned one or two things. So just to keep in mind, valuation is an act, and anytime you hear something an act, is simply saying it's not a one-way thing, right? You are allowed to be very flexible, very flexible, and the whole thing is, does it make sense? Does it not make sense? It is applying here. Why is it not applied here? And the whole thing. So thank you for taking your time. Take us through this, and the next session we then go straight to the practical aspect of it, where we put all the variable together and how that also
Yeah.
tie into this our model build. So thank you once again.
Yes.
Yes. Thank you, and we really need to appreciate our good friend, right? Of course, um, some of us that work in a typical consulting firm where you know you are being paid per hour, right? So which means if you are working on a project, if you are spending 5 minutes on this kind of projects, you know the amount that is being accrued to your name and all those things. So Dolamu is a senior man, right? And I'm quite sure his 2 hours might be worth around something like 2 million um plus or something. So thank you so much for giving that to us for free. All right, so next session will be we'll communicate the next when the next session will be, where we try and ramp up our model. So please, I've shared this model with us already, and if you've seen the model, you realize that I made some significant adjustments, right? So that's and that's also tied with what uh, Dolamu was discussing with us. It's not a one-way thing. And then you most modeler just build model and they leave it. I said, no, you need to take a step further. Does it make sense? Is this realistic? Because if you build a model and everything is fine, right? But the part of the valuation just make everything clean. And I could remember I said that most companies that are being quoted and you see their share price value or you see their company value, if we actually if you recompute the valuation, uh most organizations are overvalued. That's the truth part of it. But there are some other aspects of valuation which can actually make a business uh, value to be way higher, right? And Dolamu kind of mentions some part of it. Number one, realistic assumption, but there's something that goes way beyond the assumption of the financial forecast, the management, the strategy. For a simple tech, right? Users is a value on its own. Average revenue per users is a value on its own, right? Subscriber return on investment is a value on its own. So the valuation just kind of has a lot of wings, but you as a modeler, what is even this thing saying? So it's flexible. And looking at this model, I did some significant adjustments, right, just to make everything realistic. That do you think this is achievable? This is not achievable. This and this. How will this affect the value and the whole thing? So profit or loss account, all right, most in fact, yes, we are building the model. You want the client has paid us, they want to use this to get finance, and they want everything to look good. But the reality of most fintech, it usually take them 3 to 5 years before they can even scale through losses. Yes, it's always not that easy, right? Everybody keep painting the whole thing like it's good, but at least from experience and company that have started and they have to raise another series of funding and the whole thing. So it's what it is, right? So we adjusted that, and you can see that there's also a significant cash flow coming in. So it's not a one. Yes, your clients can tell you this is it, this is it. So when you are done with the model, you build the first one. Yes, everything they have. Then you have another one which you've actually done all the adjustments. So you show them, oh, this is what you've given this and that, this and that, and that. But as I said, you're also a financial advisor. So we think this some variables, and this you need to reconsider if you want to this business to really sustain and all those kind of things. Then you open up the second one which you've adjusted. You've done all your adjustment to make sense, to make it look like yes, it makes a whole lot of sense. So you can see your period one, the cash is a little bit low. The previous one, the cash was negative. Then second period increased. Third period, they had to bring in, just have to factor in that financing, maybe something around 100 million if they want to really push to get to that revenue they are looking for, because it's all about cash. Year three, then year four, year five, you can see the cash is significantly low because what they to increase their revenue, they need to give more loans. And in giving that loan, you are eating up your cash. And you remember we have that time frame. They will give you this loan, take you 6 months, and the whole thing just kind of affects cash as well. So if you go to the inputs, you can check that out on our own to see. We also have to switch that financing option. All right. Most times, most of these financial institutions, they kind of rely more on equity as a whole. Dollar also gives some insights to that. So you can always check this out. And if you have any comment, any review, anything, we can always discuss that as well. So thank you, everyone. And please, I would also appreciate if you could share one or two things that we've learned from this boot camp on our respective LinkedIn profile, right? So please, we are pleading. This is more like a means of appreciating this great content that we've shared with us, right? So the we'll communicate the next session to us. And thank you so much, Adedolamu. And here we'll be dropping the mic and hope to see us in our next session. So bye for now. Make sure you enjoy yourself and make sure to take good care of yourself. Health is wealth, right? So don't should not forget that. So see you in our next session, which will might likely be the last session of this our bootcamp program. So thank you, everyone. Let's make sure you enjoy ourselves, and bye for now.
One. Bye, everyone.
Thank you,